joining us today. I wanted to introduce you to two dynamic panelists at very different stages and I think that this conversation will be very insightful. Ashley, can you introduce yourself to our audience? They probably know you mainly from Farmbox, but tell us what you're up to now.
Yep, thank you. So I'm Ashley Tyrner-Dolce. I founded a company called Farmbox RX that was acquired last May. I now joined a healthcare investment firm called HLM Investments. We invest in payer services companies that are growth stage, but really work to help save the payer time, money, and make them more efficient.
And Chad?
Hi, I'm Chad Janis. Prior to starting Grüns, I was a private equity investor at Summit Partners. I sat on the board of about 12 different direct-to-consumer businesses. I started Grüns in August of 2023. We're a comprehensive nutrition green gummy bear, probably spamming your social feeds. And it comes in a sachet, about 8 gummies in a pack.
And you've probably seen Grüns featured in our Inc. profile a couple times for their hypergrowth. They are the gummy company that is scaling at the same rate as an AI company.
Yeah, it's nice of them to say that.
Yes, yes. So which was a reported $500 million valuation in roughly 2 years.
A year and a half.
A year and
a half in April of last year.
Impressive. Yeah. Congratulations. I wanted to talk a little bit about, talk a bit about the journey between going from investor to founder and then the opposite for you.
I found the path from investor to founder to be pretty streamlined. I think that a lot of investment firms, you sort of sit more on the strictly investment judgment side and not necessarily the operations, helping the businesses out. The role I had at Summit Partners, I actually got to be involved with the companies, participate at a board level, sit down with the management teams, and so I felt like that was actually a really helpful educational period for me when I came to Grüns and started the business, to be able to sort of have seen a lot of the different aspects of what a high growth consumer brand experiences.
So I had never raised $1 venture capital in my company Farmbox. I bootstrapped it, so it was actually very comical to a lot of people that I actually became an investor when I sold the company. I joke that I entered retirement for all of about 3 days because that's all my retirement lasted. I sold the company. I'm like, I'm never doing this again. It's awful. I'm retiring. It lasted 3 days. But I think what I bring to the table for HLM Investments is a unique seat as an entrepreneur that didn't raise any capital, and really being able to mentor, CEOs, especially young CEOs, and founders on how to remain being that hustle mentality. Even after you get a big check, you still got to remain in that hustle mentality, like how we did bootstrapping a company. And I think that that's something that not every investment fund really focuses on, and we really have now with the team that's at HLM. A lot of us are prior operators, so we know what it's like when SVB Bank goes down and you don't know what to do. We come from the operating side to know, when times are rough, how to handle that.
What are those lessons that you, the experience and the two different backgrounds, when you think about your growth strategy, what's the one thing that in the early days you would have possibly changed?
I think for us, because we didn't have a big check, right? We were not so focused on the hyper growth of just how many customers we could get. Like gaining land was really important to us because we created a category in healthcare. So we were the first to market, the first to do it, created the category. Competitors came after that. But we really looked through the lens of how to remain profitable. Because if we were not going to take any investing, we had to make money on every box that went out the door. I can remember, meeting with investors and they're like, yeah, how much are you guys burning? And I'm just like, at first, I was like, what does that even mean? No, we make money on every box that goes out the door. So I think thinking through that lens was really, really important to us early on.
Yeah. And Chad, I know that it's a different stage for you because you literally just launched a few years ago. So how the decisions that you're making right now, you've taken capital early. what was the thinking behind that? And when you did, what were the things that were a bit unexpected when you are taking external capital?
Yeah, so I knew from starting the business that we would raise capital. We've always had profitable economics, but profitable economics doesn't necessarily mean profitable income statement. No need to raise capital. And the way that works is if you make more money on repeat purchases, then you need to fund the initial acquisition to offset that. And so similarly, I think coming from private equity, the firm I was at, we only invested in profitable businesses. So that model is everything I brought to the business, ensuring that we had that discipline as we started the company. I think one thing that I would say to answer your question about what was unexpected, I would say that if the economics are profitable, you don't have to raise money that much into the future of the business. As growth rate slows, still very fast, naturally your repeat customers offset any losses of the new, which has been part of the reason why we've been profitable now for, I think it's close to 18 months.
I was going to ask, there's kind of like that moment where founders always consider whether or not it makes sense for them. When was that inflection point that you were going to take outside capital? Because, I mean, Grüns was, again, revenue was great, you were profitable. What was the intent behind it making sense for Grüns?
So we could have always slowed growth down to ensure that repeat customers made up a greater portion of our total revenue. The critical decision that led me to say, hey, we need to raise money is I never wanted to be in a position where we're thinking about ways to transform the world and change the supplement industry. And the thing stopping us was, hey, we got to watch out for cash flow. So I always wanted to be building this company from a position of strength, that if we had a big idea with something that we felt really bullish on, that we would have the funds to go do that and not be worrying too much about, it's this decision versus another one. How do we fund it?
What would be, from the investor perspective, like what would have been your advice to, again, oftentimes you think about hypergrowth and throwing capital at it isn't always necessarily the smartest move. As an investor, what would your advice be to founders?
Well, at HLM, we're really only investing now in growth stage companies, and so they need to be profitable as well. And sometimes that doesn't mean that we're pouring, fuel on the fire to grow faster. I don't necessarily think growing faster can always be the best, right? You also, maybe we're having to invest money to help the company invest in their technology stack, which will make them more efficient, which will make them more profitable, which will make them a better value add to an insurance payer that they work with. So for us, we take a look at each deal around not just how fast are they growing, but how will this investment fuel them to the next category, and how can it make them become more valuable to a payer? Because when you work with health plans, the goal is to embed yourself so deep as a vendor within that health plan, and you've got to now do like 5 things. Yeah. You can't just do one thing for them because the purses have gotten tighter with the new administration in healthcare, and you've got to make it that they cannot get rid of you as a vendor.
You famously bootstrapped Farmbox and talk about how that actually was a strength. That you didn't, initially were rejected and were forced to bootstrap Farmbox. When you talk about that actually being an early on strength, elaborate on what you meant by that.
So I did try to raise money a couple times, and my terms were not good, the healthcare side of investing, when they were going to give me money, so I walked from it. But, I think because for me, right, we were also a mission-driven business, right? We really created the food as medicine category in healthcare, where a health plan, a payer like United, Centene, Humana, covers the box of food for a member. And I took that very serious, and that was always our North Star. Like, what do we got to do to get food to people who need it most? And for us, that was low income and also seniors. And so I didn't want to have anybody at my board table that would try to put my company in a different direction, because I took very serious that we broke into getting a health payer to cover food for members who desperately need it, right? And for me, I had a lot of deals that came my way to sell the company that were very good for me because I owned most of the company, but were not going to be good for the company long term and the mission of the company. So I think that, for us, being a mission-driven company was important that I remained in control of what the decision would be going forward for it.
What made you think that mission would have changed if you had infused outside capital?
Well, a lot of conversations with investors. We had investors that wanted to make us a meal kit, and maybe you should just do medically tailored meals. And when we finally found our product market fit in healthcare, we knew we landed on the way as honestly a roadmap to other companies to get payers to cover food, right? So I like to have always said that I didn't have to own the whole table. I could let another company have a seat at my table, as long as I was, the main conversation at the table.
The meal kit decision was interesting, right? Was that the moment when you decided, no, this is actually better that I've been forced to bootstrap it because I can keep my vision intact?
Yeah, no investor wanted me to really focus on the food desert problem America faces. There's a very common misconception that just because somebody's low income, they don't want to be healthy, they don't want to eat healthy. They do. They can't afford it. They don't have accessibility, and they don't know how to eat healthy. When you solve those things, nobody wakes up and says, I want to be type 2 diabetic, I want to have breast cancer. Nobody wakes up and says that. The same goes true in healthcare. If you solve people being able to seek healthcare, have accessibility, and afford healthcare, they'll go get their mammogram. They'll work on their type 2 diabetes.
That's it. That must have taken a lot of conviction, though, to say no.
Yes, it did. But I think as an entrepreneur, it's really important for entrepreneurs to never get away from what their North Star is of their mission of the company. So for ours was always to get the box of food, healthy food, to members who need it most, and that was low income and seniors. And we actually had to pivot and become a member engagement company in healthcare rather than a food company.
Let me ask you the same question, Chad. I mean, what is the North Star for Grüns?
Yes, I actually agree with Ashley on this. I think as I'm listening, it would have been a huge mistake to raise money if there's a bifurcation of opinions about how to execute, the terms, like everything that is the North Star of the business. For us, the North Star has been to transform the entire nutrition and supplement category, which is a very grand, sort of ambiguous North Star. I think people are starting to see that as we've launched additional products beyond just Grüns to nootrops and juiced and immune. And frankly, we haven't had those two very critical issues of misalignment with investors. Our investors have always trusted us and said, it seems like you know what you're doing, we'll lean in, here's some money, keep going at it. And then second to that, the terms that we've raised at, there were frankly a lot of investors that we turned down because they wanted to throw a bunch of unique structure in the deal, and we were very clear we don't need to raise. If we're going to raise, it needs to be the right partner with very vanilla terms.
What was the right partner when you are assessing, outside capital and you're looking for that part? What were the various different aspects that you looked at that for alignment with your own company?
Thing number one is alignment and vision. So the partner in our most recent round about a year ago, had complete belief in our ability to not just push through what other supplement brands have done, but become a multiple billion revenue business, and what that path looks like. And I think that was quite unique in the partner that we chose. Additional to that, they have international capabilities. The most recent round we raised is from Headline. They have a very large office and force out in Europe, and so we felt like that would be helpful, and it has been helpful as we're expanding internationally soon. But even beyond that, I think it's really just at the end of the day is their alignment in strategy, belief of what this could become. If there's misalignment in that, it's going to show up in very bad ways when one day you look to exit the business, IPO, whatever it happens to be. That will cause a lot of issues if you don't have alignment up front.
You and I talked a little bit about that, Ashley, in our call initially, about how the type of partner that you want when you are looking for investment. Talk a little bit about that, especially now from the other side of it.
So I think for any entrepreneur that's going out and raising money, you want somebody that's going to be on your board seat or on your board table that can bring value to you beyond that check, right? So, you want somebody, especially I think in the world of healthcare right now, that it's changing very rapidly, the Medicaid market, the Medicare market. You want somebody that's going to bring wisdom to you, right? You want somebody that has connections, that if you're having a problem with a payer in this market, they can pick up the phone and call the president of the market, right? And say, we have this solution. Can we sit down? Can we meet for lunch? So when you're going out to raise capital, it's not just, I like to tell entrepreneurs, you really need like a business plan around it and a blueprint. It's not just, I need to raise 10, 20, $30 million. What wisdom and what value will these investors bring to my board that I can pick up the phone and I can call when I need advice on something? It can even be product advice. I mean, they joke at HLM that they should have invested in me because they never made any money off of me, and I used to call the partners all the time, and I would ask them for advice. But they were able to really guide me in the path of being a member engagement company, and also that product. How can we expand this product? Where else do you see that this product can bring value to the payers that we work with?
Being a founder who struggled to raise capital in the beginning, in your farm box days, how has that changed the way in which you assess companies that you are looking to invest in?
I like to say that every entrepreneur that I would invest in really needs to have that hustle mentality. I did not take a true vacation in 11 years of the company. 7 days a week I was available. I've had a payer call me on Christmas Day and need to submit a purchase order, and I took the call. So I think having that hustle is really, really important. And I think also an entrepreneur, and you might be able to relate to this as well, but I think an entrepreneur that understands sometimes that the team that gets you to maybe 10, 20 million is probably not going to be the team that's going to get you to 100, 250, 500, a bit, right? And those are really difficult conversations and situations to have because you've had somebody since founding that's been there, that's grinded out, hustled out, but they don't have the wisdom and they don't have the skill to get you to the next level. And so I think that that's another, how an entrepreneur can adapt to those tough conversations and knowing when it's time to bring another individual in to run product or to run marketing, or it might even be a chief operating officer that you'd have to bring in.
I've asked the same question for you, Chad, seeing it from the flip side of it. What are some of those lessons that you have learned after being an investor and now founder? Did it help you kind of be forward-looking as you're growing Grüns?
I was very lucky during my growth equity experience to meet amazing management teams at each of the companies I sat on the board of. And so I frankly had that experience that you were just talking about where you see the types of folks it takes to grow from 0 to 10, 10 to 50, 50 to 100, and so forth. And so we've been fortunate. I think that's one thing I've carried over is, when people tell me, hey, Chad, you're doing such a good job, the business is growing so fast, I'm quick to remind them, hey, there's 130 of us that are doing a good job. There's a lot of people with a lot of talent who are working every day with a founder mentality to grow this business and achieve the vision we have.
You've brought on some high-profile investors, Joe Burrow, Shaun White, the Olympian, Anna Kendrick. Do these high-profile investors, do they add credibility or do they create a little bit of skepticism around your brand?
I would say it's credibility. We don't lean too heavily into individuals too much. I think that's probably a very unique aspect of Grüns. It's for the people, not necessarily for a specific person, or we have that one person that's always sort of the face of the brand. I'm not even really the face of the brand. And so I think it's credibility, but first and foremost, each of these people, what I love most is they're serious people, but they don't take themselves too seriously. If you think about Shaun White, he sort of emulates that aspect of Grüns in the same way that we are.
I would probably ask the same thing of you, Ashley. if given resources being limited, and being a partner in the companies that you invest in, when does that make sense to bring in high-profile investors, and does it?
So I think it's really to every company's what their needs are, right? If you're going to bring in, maybe it's a new chief operating officer, it's because whoever you have there currently is lacking, right? And I think that's some wisdom that a great board can bring your way too. They maybe have contacts, and they may be able to help you in understanding that decision of when it's time to bring in other individuals. For me, you said you're not really the face of the business. I was the face of Farmbox, and I have been very difficult to get away from being that face. But I remained true at the company. Like I used to say, I literally would tell my team this. I've done so many interviews, I've said this. Like I am the least smartest person at Farmbox. Like I surrounded myself, like I was the visionary, I had the ideas, but I surrounded myself with a really incredible operating and management team. The best person for product. I was very fortunate of my chief operating officer who ran the hardcore analytics side of the business every day, which is not where I did well. And so I was very fortunate that I was able to surround myself with some of the brightest minds in healthcare to really paint that vision that I had of Farmbox.
Let's talk about your first real term sheet. What was surprising?
The terms of the term sheet.
Yeah.
I think I had 2 or 3 times. What did I have? I had 2 or 3 times what was it?
Liquidity preference.
Yeah, they took their money. They took their money times 3, and then got to participate in the common, which the common is like what I owned. And my employees that were vesting, and so I was just like, well, what if we sell, like I get only maybe 10 million that we get to, and you take all of the rest. So I like to tell all entrepreneurs, you need to take a look at your terms. I see so many entrepreneurs that are like, oh, we just raised at this valuation, we are $200 million, and it's like, let's talk about your terms. What were your terms on that?
Okay, let's talk about those terms. What should founders be on the lookout for in terms of what are the negotiation terms that they even can leverage?
Well, one, I think if you have a really good product and you have really great product market fit, you're in a better negotiating spot, right? And as you go, in a B, C, D, you have a better negotiating than with maybe you have some angel investors, easy, but Series A is, I think, the most difficult for entrepreneurs. Yeah. And you need to pay attention as to what your terms are of your preferred, right? And because just as I said, you could literally have a $100 million deal, 2 times preferred. Maybe they put in $20 million to buy half of the company. There's $40 million that they get before you even get anything. Then there's 60, and then they take their half of 60, and then you, who's hustled this entire time with your team, get to participate in half of that 60. That doesn't really seem fair.
Yeah, I'd ask the same question for you, Chad.
To me, there's 2 things I would encourage founders to look at. First is one-time liquidity preference. That's about it. So when you talk about all the structures, anything beyond a one-time liquidity preference, meaning they at least get their money back, I think is too much. And what you're referring to is participating preferred. I even think that's too much. But to be clear, you have to have a business that's in a place of strength, right? Yeah. That's why often those terms are thrown out there. The second thing I encourage every founder to do is maintain control. At the end of the day, whether you're selling your business and you own 100% of it, 60% of it, 30% of it, as long as you have control and can will into existence the vision that you had, then I think you're going to be happy with that 30, 60, or 100% of a big sale, whatever that happens to be. And so 2 things: maintain control, don't accept anything beyond a one-time liquidity preference.
I mean, we had Mark Cuban on yesterday, and he actually said the first thing he mentioned was don't take outside capital, because the first thing you do is give up control. Don't take money from a shark like me.
He's probably a good negotiator if he's getting control off of the first deal.
But what were were the things that that capital infusion unlocked for Grüns that, between product launches, et cetera?
Yeah, so product launches, we've accelerated. We've got 4 gummy scientists who are cooking up gummies every day. We're bringing 12 new innovations to market over the next couple of years here. Beyond that, we've launched into a lot of retailers. Retailers have cash flow considerations, like you ship the product, you have to front the cost of the product, they pay you 30, 60, 90 days later. So you have to float that cash. And so for us, even as a profitable company, having that cash to provide for the growth avenue we wanted was very important as we launched Sam's Club, Costco, Walmart, Target, and a bunch of grocery along the way.
So we were very lucky because it's funny, we are the yin to the yang of each other. You guys selected well here.
Yeah.
So we were very lucky that, and one of the reasons we didn't have to go raise capital is because, like we shipped the box with FedEx. Like, I beat up FedEx for like 60-day terms, right? So they would ship the box. I got paid within, 15, 30 days from my payers. And then we could hold the money for 30 to help fund and then pay FedEx. Same with like my vendors. And so there is when you have product that you've got to buy and fulfill, like you have to go raise, right?
When you talked about the capital infusion, the fact that you have a good working relationship and partnership with your investors, what do you feel that you did in specific that allowed you to kind of maintain full control?
First and foremost, the business is doing very well.
Yeah.
We were profitable. I think my encouragement to founders who are looking to raise is to start that process well in advance of when you need the money. If your back's against the wall and you go to negotiate, they're gonna suss that out pretty quickly, and therefore you're gonna have to take whatever deal is given to you. In our history, I raised basically every 6 months. In the moment we would close a deal, I was basically re-engaging with investors and sort of trying to get them to bite on it, asking to give me money. So it was sort of their idea, even though that was what I was hoping they would want to do. But it was always from a position of strength that allowed us to raise at really good terms.
If you could leave founders with one rule for raising and staying in control of their company, what would that be?
I think it's start early, at least 6 months before. The best case scenario is that an investor is coming up with the idea of investing in you, right? You're not really raising, that's what you tell them. You're not really raising, you're more so just interested in a conversation and meeting partners if there ever comes a time. And then as you sort of slip in little things about your business, ideally they say, hey, would you consider raising money? I don't know. Give them some information. You've got a term sheet.
It's like dating.
Yeah.
Like you tell, you don't, when you're dating, like, oh, I'm busy tonight. It's that kind of concept, yeah.
100%. You've got to start early is the key there.
And when should a founder walk away, even if the money's attractive?
If the terms are really bad, that's one. And I think too, look, as a founder, you touched on this, but your board should believe in you, right? And you want to have people that are investing in you that believe in what you're doing, and you as an operator. So if you as an operator are doing well and growing the company and pushing yourself towards profitability, there's no reason for your investor to not want you running the company anymore. When you see like a CEO shakeup, it's usually A, the CEO is burnt and done and ready for a break. B, they've taken it as far as they can and they need to bring in, someone else that's going to get them to the next level. And then C, there's also, they're not doing a good job and they've got to replace that individual.
Yeah, and I'd ask the same question from you as well, Chad.
One more time on the question.
When does it make sense for a founder to walk away even when the money is enticing?
So hopefully they have a plan B, right? Like hopefully you're not in a position where you absolutely have to raise. So for us, we might have walked if the terms were terrible. And I'll be honest, you look at a business like Grüns and think people are like, of course you've raised money, of course the terms have been great. It was not easy along the path each time we raised, despite this wonderful growth that we've experienced. And so every founder faces it, and if the terms had, maybe relating it to myself, if the terms had been bad, we would have made the choice, hey, maybe we're not launching that retailer, maybe we're slowing down growth to ensure we have more profits to fund our own cash flow. And so I guess to answer the question specifically, if you're in a position where you have a choice, I would walk away if the terms are bad, and you can slow down growth or do something to sort of control your own destiny going forward.
On that note, thank you so much, Chad and Ashley, for joining us today.